The stock rally is hanging by a thread right now, and the weird part is it's not really oil calling the shots anymore. It's AI. Yup, the same two letters that have been dragging this market higher are now the thing investors are staring at like it's the final boss of earnings season. So if you've been wondering whether this rally still has legs, or whether we're about to find out it was all hype, stay with me, because this week could tell us a lot about where stocks go next. Hey, I'm Vanessa, and I break down the market in plain English so you can actually use the information, not just admire the charts from a distance. And today, we've got three big stories that all connect back to one thing: what's really powering this market, what could slow it down, and where investors may be getting a little too comfortable. Let's start with the biggest setup of the week. Earnings season is here, and the market is basically about to ask companies one brutal question. Are you still spending on AI, or are you starting to pull back? That matters because this rally has been leaning heavily on the idea that AI investment will keep feeding growth, margin expansion, and future profits. Not someday, right now. That's why this story matters so much. If big companies keep pouring money into chips, cloud infrastructure, data centers, and AI tools, investors will likely keep rewarding the names tied to that theme. But if executives start sounding cautious, the mood can shift fast. And here's the funny thing. A few months ago, people were obsessed with oil prices and whether energy was going to drive the next market move. Now, oil still matters, of course, but AI is the bigger emotional trade. Why? Because oil mostly tells you something about inflation and costs. AI tells you something about future earnings growth, productivity, and whether this market's favorite story still has room to run. That's a much bigger deal for stocks. When investors are willing to pay higher valuations, they're usually betting on growth that hasn't fully shown up yet. AI is the poster child for that bet. So what should you watch during earnings? Three things. First, capital spending. Are companies still increasing budgets for AI infrastructure? Second, management tone. Do CEOs sound excited, or do they start using words like measured, disciplined, and selective? You know those words. They're corporate for we're not as aggressive as before. Third, actual monetization. Because at some point, the market is going to stop giving free passes and ask how all this AI spending turns into revenue. That's the open loop here. Everyone loves the promise, but the payoff only comes if the numbers start proving it. Now, let's zoom out to the bigger macro picture, because the second story this week is all about whether the US economy is cooling, holding steady, or quietly setting up a surprise. Bank earnings and inflation data are front and center, and that combination can move markets in a hurry. Why? Because banks are basically a live pulse check on the economy. They're seeing consumer spending, business borrowing, credit quality, loan demand, and stress in real time. If banks sound upbeat, that suggests households and businesses are still hanging in there. If they sound cautious, the market has to start pricing in more economic strain. Then you've got inflation data, which never really leaves the stage, does it? Investors want to know whether prices are still sticky enough to keep the Federal Reserve on alert. And that matters because the entire stock market can reprice around one question. Are rates likely to stay higher for longer, or is there room for cuts later? If inflation comes in hotter than expected, that can squeeze valuations, especially in the kind of growth names that have been leading the rally. If inflation cools, that gives the market more breathing room. Simple in theory, messy in practice. Which is very on brand for markets. And this is where a lot of investors get tripped up. They treat earnings season like a bunch of isolated company updates. It's not. It's a giant pressure test for the whole story the market has been telling itself. Are consumers still spending? Are margins holding? Are companies absorbing higher costs? Is demand slowing? Is AI helping productivity enough to offset wage pressure? Every report is a clue. Put enough clues together and you get the real picture of whether this rally is backed by something solid or just floating on optimism. Now, for the third story, and this one is a little spicy, why this could be the worst time to buy SpaceX stock. The key point here is that SpaceX stock is trading around its market open price, which sounds neutral on the surface. But the bigger issue is what that price may already be assuming. Anytime a company is tied to huge hype, huge expectations, and a massive future narrative, investors need to ask a very uncomfortable question. What if the good news is already priced in? That's the trap with high-profile private or quasi-private growth stories. People see the brand, the mission, the headlines, and suddenly they're not thinking about valuation anymore. They're thinking about being early. But being early is only great if the price doesn't already reflect a lot of the upside. If the market has already assigned a rich valuation, then even great progress can disappoint investors if it isn't better than expected. That's why worst time to buy is such a strong phrase. It doesn't necessarily mean the business is bad. It means the risk-reward may be off. And this is where the broader market lesson kicks in. Investors are reaching for the next big growth story at the same time they're being asked to judge the current state of inflation, rates, and earnings. That's a lot. So the temptation is to pile into the hottest names and assume the upside will take care of itself. But markets don't reward enthusiasm by itself. They reward timing, pricing, and execution. If you buy a great story at the wrong valuation, you can still lose money. That's the part people hate hearing, but it's true. So how do these three stories connect? Easy. They all point to a market that is trying to decide whether the next leg higher is real or just built on one overcrowded theme. AI is driving the optimism. Inflation and bank earnings are going to test the macro backdrop, and speculative growth names like SpaceX are reminding investors that hype can get dangerous when expectations are already sky high. If you're investing from home, this is the moment to get a little more disciplined, not less. Don't just ask what's exciting, ask what's priced in. Don't just ask what's growing, ask what's growing enough to justify the valuation. And don't ignore the boring stuff like inflation and bank earnings, because those are the numbers that can change the entire mood of the market in a single week. Here's the practical takeaway. If you're overweight the AI trade, keep an eye on whether companies are still spending aggressively and whether earnings calls support the narrative. If you're trying to read the broader market, watch inflation closely, because it can influence rate expectations and stock valuations fast. And if you're looking at high-flying growth stories, remember that a great company is not the same thing as a great entry point. Those are two very different questions, and the market only rewards you when you respect both. So yes, the rally still has a story, but this week is going to tell us whether that story has real earnings behind it or whether investors are getting a little too comfortable with the same old AI optimism. And that, honestly, is the part I'd be watching most closely if I were you.